Okay, sorry, I listened to that again and I realized what I had just said incorrectly. We are asking ourselves here if our relevant revenue is more than our relevant cost. So I said that incorrectly in the very last video as I was finishing up. So is the relevant revenue more than the relevant cost here? Yeah, it is. We're expecting to get $60 from this new special order, and it's going to cost us $55 in costs that are relevant. Now again, remember, we have costs that are going to be incurred still, product facility costs, but those aren't relevant. Those are incurred. It doesn't matter if we take the special order or not. These just don't matter. So what matters to us is what is the relevant, meaning what could be avoided if we don't take on the special project, or what costs do we take on because of the special project? It's $55 more per unit. So $60 revenue, $55 in relevant costs. That is a $5 profit per unit. Let's see here. What would be the change in profit? Well, if we have 2,000 units and we are going to have a relevant profit increase of $5 for each unit, then it is just $10,000. That is our change in profit, $10,000. Again, we're only looking at the relevant costs. That is what our change is. If we wanted to recreate this entire, kind of similar to an income statement, we wanted to list out the new revenue, we want to list out all these expenses, and we wanted to list out the fixed items again. If you rewrote all of this with the addition of the 2,000, so if you change this to 9,000, 9,000, and 9,000, and then found the difference, you would see it would go up by $10,000 because of bringing in 2,000 more units. So do we accept or reject? Well, we definitely are going to accept it. Yeah, for sure. Because again, our relevant revenue is more than our relevant cost up here. And it will bring in positive profit for taking on this project. All right, now to talk about something a little bit different, and that is outsourcing. You also hear outsourcing called a make or a buy decision when we come to outsourcing problems, because when we talk about outsourcing, we're looking at if it's cheaper to have parts made somewhere else as opposed to making them in-house. So when it comes to outsourcing, our question here, let's kind of separate that for a second, is if we should buy goods or services from other companies. That's the question here. Rather than producing internally. I think this is more and more relevant in our current economy because there's a lot of questions about bringing things back to the United States and making things made in America. Made in America. I hear that all the time. So companies are really having to focus on, is it important to us, or could we, not necessarily important, but could we, or is it more profitable to make goods in-house, internally, or to buy them externally? That doesn't necessarily have to mean overseas. It could mean, company down the street. But this is something you'll hear in the news a lot. Kilgore Company makes and sells a single product. Change that over here. Kilgore incurred the following cost on its most recent fiscal year income statement. Now, they could purchase the products that it currently makes. If it purchased the items, the company would continue to sell them using their own logo, advertising program, and sales staff. So we don't have to worry about the advertising, sales, logo. Those things still remain. They're still going to have those no matter what. Still have no matter what. Determine which costs are relevant in deciding or make or buy in this outsourcing decision. Which of these are relevant or irrelevant? We've already looked at this. We know what this relevant and irrelevant means, but now we're just going to apply it to a situation of, are we going to have these costs if we make it and if we buy it, or are they different between those two alternatives? So we've got two options. Our options are make versus buy, and we've got to ask ourselves, are they different between the two? If they're different cost, then they will be relevant. That is the definition of relevant. Materials cost, $7 per unit. If we make it, are we incurring that materials cost? Yes, because we're making it. So absolutely. If we buy it, are we incurring that material cost? No. If we buy it, we do not have to pay for the materials. So we say this is a relevant cost for us to consider. And we know that it's per unit. That makes it a variable cost. Maybe I should write that out entirely. We'll just leave it like that. You know what I mean. All right, company's president's salary. Company's president's salary. Is it the same if you make it and you buy it? Yeah, probably. You still have to have a president. So we don't need to worry about that. That's irrelevant to us. Whatever their salary is, it doesn't matter in the make versus buy decision. And of course we know it doesn't matter how many units they make, it remains the same. Depreciation on the manufacturing equipment. This one's kind of hard. If they already own the equipment, it's just sitting there, they've got some big machine, little doodaddies and some smoke coming out of it. If they've already got a machine and they are going to keep it no matter what, if they make something and use that machine, that's great. If they buy something, they still have that machine. That means the depreciation they're incurring is still there. It doesn't matter if they make or buy. So that one's kind of weird. It is irrelevant, and we know that it's the same every month. It is a fixed cost. It does not matter how many units that they create. That does not matter. It will remain fixed. All right, why don't you walk through these? I'm going to fill out my table too, so go ahead and pause it. I'm going to fill out my table, and I'll come back to some of the ones that are important. Okay, so you can check your work here, see what you've gotten, or send me an email if I've gotten something wrong. It happens. Hopefully not today. But a few things I do want to point out. The rental cost of manufacturing facility. Now, I'm going to assume here that this rental cost means that they are renting the manufacturing facility. And if they're not manufacturing anything, then they don't have a facility to use. If they're not making anything, they don't have to rent it. So this is relevant to us. Maybe it's also, well, we'll leave it at that. Yes, it is relevant to us. Some other things, you do see things like your shipping and handling and your commissions. Those would be things that are incurred after production. So it doesn't matter if you make or buy, you're shipping, you're getting commissions to your salespeople. So those are relevant costs. And your production supervisor. We don't need a supervisor if we're not making anything. Okay, so I'll remind you, as you're going through these problems, ask yourself, would the cost be different if you make it or you buy it? And if it's different, it's definitely relevant. All right, so the question doesn't ask you what is the total relevant cost, but if it did, we would go back through here and we'd say, what is the cost to produce each item? And so then we'd have material cost, we would have the rental cost, we would have the labor cost, and so on. So the relevant costs, we would identify them, and then we can add them up. Okay, so simplified version of this. Tao's Toolery is operating at 80% of its productive capacity. It is currently purchasing units for $20 each. That's what they are buying units at. Each part consisted the $20 each a part used in its manufacturing operation. Tao estimates it can make the part internally for a cost of $24. Okay, now immediately you'd say to yourself, Miss Barron, wouldn't it be easier to buy it than make it? Well, it's costing $24. Okay, but what's relevant? Is the whole $24 relevant? We need to ask ourselves, what's relevant? This $24 that they're paying to make their units consists of $18 production cost incurred for each unit, such as labor and materials, and $6 that would be allocated to each unit incurred for the entire factory, facility level cost. These costs would be incurred regardless of if they make or buy. We would have, maybe it goes back to our depreciation, or maybe it goes back up to maybe a president of some sort. I don't know, but this is entire factory related, and it is only allocated to each unit. If they choose to make these parts, it will cost them $24, but only 18 of that is relevant in this decision, because that other 6 would be allocated to another product line or unit somewhere else. So they're still incurring that cost. It's just going to go to a different unit or product line. What is relevant here? When it comes to relevance, the only thing relevant when it is the make or buy is that $18. They've got a $20 part that they could buy, or they could make it in-house for $18. What is the differential increase or decrease in cost derived from making the part rather than purchasing it? What is the increase or decrease? What is the difference in buying it versus making it? So this is even hard for me to wrap my mind around sometimes. I'm like, but that's $6. Yes, but if that $6 is not allocated to this product, it will be still allocated to somewhere else. The company will still incur that no matter what. Incurred regardless. That $6 is just somewhere else. So what is relevant? Just that 18 when it comes to making it. What is the differential increase or decrease? Well, when it comes to buying it, if they buy it and it's $20 versus if they make it and it's 18, then that is a $2 differential. And they have the possibility of making, let's see here. Oh, they purchased 50,000 units. So $2 at $50,000 or 50,000 units means that they have a $100,000 cost differential. And that means if they decide to make it, their cost would go down by $100,000. Now, we always have to ask ourselves, do they have the capability? Do they have the ability to do that? Is it the same quality? There's a lot of other qualitative factors, but when it comes to just the numbers, then yes, it would be a $10,000 differential if they make it, because that is what is relevant. All right, the next thing to look at is something called segment elimination. We're still working with our relevant and irrelevant information, but we're going to take an entire company and we're going to look at it in segments, things like by divisions or products, territories, the east, the west, the north, the south area, maybe in different centers or services. And we're going to break out the information for these segments, a profit and loss basically, cost and revenue, not looking at the entire business, but by segments, so that we can identify which are performing well, and which are performing well or poorly, instead of the whole. So it is going to be a more zeroed in look at these segments to figure out which ones are performing well or which are performing poorly. And by identifying these items based on only what is relevant, then we can make a decision to maybe eliminate them entirely. You might see businesses like Sears, or when we had Toys R Us still open. Some of these businesses, they were like ghost towns. They just weren't, nobody was going in on them. They weren't even getting any attention from customers. And the question I have for you is, why did Sears, along with those types of other retailers, Blockbuster, why did they stick around for so long? Why did they stay open even though they weren't, the whole business as a whole was not performing well? They stayed in a loss for several years before they completely closed. So why did they stick around for so long? Well, as we're going to see here with these different segments in a second, sometimes businesses will stick around and keep their doors open. Despite not being profitable, because it's going to cover its unavoidable cost. Okay, so we're going to look at this example and then I'll come back to the Sears explanation. So based on a segment income statement below, Fruity Sorbet is considering eliminating its Mango Tango line. So we have some revenue from this special line, salaries for the workers on this line, the materials for this line. We've got sunk cost. We know that those are things that happened in the past. We cannot avoid them. And then we've got the company-wide facility sustaining costs. And when you see the word facility, and of course it's allocated, this means that this is one segment. If the segment Tango Mango goes away, this cost will be allocated to another product. So we cannot avoid that. We cannot avoid those two things. Unavoidable. All right, so what are the relevant costs in this decision? Well, if we get rid of Mango Tango, then we're definitely going to get rid of the salaries to pay the workers, and we don't have to worry about the costs. So what are the relevant costs? Well, that's just the $420,000. That's all that's relevant in this situation when it comes to this line.